Today we're diving into a classic debate: dividend stocks versus growth stocks. I'll unpack the pros, cons, and real-world examples to help you decide which strategy fits your portfolio. Let's get started. First, let's define our contenders. Dividend stocks are shares of companies that pay out a portion of their profits to shareholders, typically on a quarterly basis. Think steady, reliable income, perfect for retirees or those seeking passive cash flow. Growth stocks, on the other hand, are companies reinvesting profits to fuel expansion, often in tech or emerging sectors. These stocks aim for capital appreciation, but they rarely pay dividends. It's income now versus wealth later. Why choose dividend stocks? Stability and predictability. Companies like Procter Gamble, a dividend aristocrat, have raised payouts for over 65 years. PG's 2.4% yield, as of May 2025, delivers consistent income, and its consumer staples business weathers market storms. Dividend stocks also compound wealth over time. Reinvesting dividends from a stock like Johnson & Johnson, yielding 2.8%, can snowball into significant returns. Data from S&P shows dividend-paying stocks have historically outperformed non-payers with lower volatility. But there's a catch. Dividend stocks, often mature companies, may lag in explosive growth. If the market tanks, even stalwarts like Coca-Cola can stall, and high yields sometimes signal trouble. Think AT&T's 7% yield in 2021 before it slashed payouts. You need to scrutinize payout ratios. A ratio above 80% screams risk. J&J's 45% is safer. Now, growth stocks, they're the rock stars of Wall Street. Companies like NVIDIA or Tesla pour earnings into innovation, driving stock prices skyward. NVIDIA's stock surged over 1,000% from 2018 to 2023, fueled by AI chip demand. Growth stocks thrive in bull markets and suit smart investors with long horizons. But growth stocks are volatile. When interest rates spiked in 2022, Shopify plummeted 75% as investors fled speculative bets. No dividends mean no cushion, and sky-high valuations, NVIDIA's PE ratio once hit 90, can crash if growth stalls. Timing matters, and mistiming can wipe out gains. So, how do you choose? It depends on your goals, risk tolerance, and timeline. If you're nearing retirement, dividend stocks like Microsoft, blending a 0.8% yield with growth, offer balance. Younger investors might lean toward Amazon, a growth juggernaut with no dividend but massive upside. A smart portfolio often blends both: dividends for stability, growth for alpha. Look at historical returns. From 2000 to 2020, the S&P 500 Dividend Aristocrats Index returned 10.2% annually, edging out the broader S&P 500's 9.8%. Yet, growth-heavy NASDAQ crushed it in the 2010s. Smart investors diversify wisely. They pair PepsiCo with Alphabet. That's the dividend versus growth showdown. Assess your needs, do your homework, and build a portfolio that works for you. Next video in this series: taxes after dividends and after growth investing. Until next time, invest smart.